Hello, I'm Bernard Hickey with the daily briefing from interest.co.nz. Today we'll look at fresh signs of stress in the housing market, where mortgagee sales listings have doubled since early February. And we'll look at the increase in the staggering amount of bank lending on houses in the last 5 years. Banks are now heavily dependent on the housing market. More on that in a minute. But firstly, we look at the latest results from the interest.co.nz Mortgagee Listings Index. We're tracking the number of listings for mortgagee sales on trademe.co.nz and realestate.co.nz. The overall number is up 7% this week alone and has more than doubled since we started tracking these figures in February. It's a very interesting exercise. Just go to these websites and search for mortgagee to see what type of house is up for sale. There's a lot of investment properties, particularly anything that looks like a leaky building. And there's quite a few sections as well, as developers struggle to get funding to build houses or apartments on that land. The story in Auckland is uglier, where the number of mortgagee sales listings has risen 19% in the last week alone and has also more than doubled in the last 6 weeks. Elsewhere, the number of bankruptcies and no asset procedures, which is a sort of bankruptcy light, has risen sharply in the last 4 weeks. Times are tough and getting tougher. Now for a closer look at how exposed the banks are to the housing market. Our analysis of the banks' disclosure statements for the last 5 years show they are much more exposed than they used to be. Now, almost half of all bank assets are mortgages on land and houses. That's up from just over 40% 5 years ago. That's because of the boom in house prices and the surge in bank lending that went with it. Banks now have $148.3 billion of mortgages. That's double what it was 5 years ago. It means that a crash in the housing market and a big increase in defaults and people not paying their mortgages on time will affect the banks here. The exposure to the housing sector here is actually even greater than it is in Australia. ASB is the most exposed of the big banks, with just over 63% of its assets in mortgages. At the lower end of the scale is BNZ with 42%. It just reinforces our call last week for a debate on a bank deposit insurance scheme. Along with Australia, New Zealand is one of the few countries that does not have a deposit insurance scheme, just in case a bank falls over. As we saw over the weekend with the near failure of Bear Stearns, these things can and do happen, even for the big names. We believe New Zealand should set up a government-run deposit insurer that charges the banks, and therefore their customers, a small fee to insure the first $100,000 of deposits for each depositor. That will help reduce the risk of a run on a bank and will ensure at least some protection in the event of a disaster. It will also prevent the government from having to bail out or nationalise a failing bank because of political pressure. I'm Bernard Hickey from interest.co.nz with the daily briefing. Catch you on Tuesday.